also known as Diamond Dave, the founder of the highest paid part-time job in the world options training program. And what we're really quickly going to talk about is a company called Coursera, a stock ticker COUR. Now, Coursera is a online education platform. And when you understand, those are really, really big just because of some of the trends in the economy. Also, COVID really exploded the importance of these particular platforms where people no longer have to leave the house to get education. And then, we've all known about a lot of the online course platforms that popped up in the early 2000s have continued to build out. So educating people online, if you have a really desirable product that people want to learn about, and you can build a really good model around it where you can attract new people, you have a good long-term customer value because you have good course content, you got a good ecosystem, it can be very profitable. Because the thing about a digital product is it can be sold millions of times over and over again without depreciating the actual product. Unsimilar to like if you're buying something physical, the product depreciates over time and it costs a lot of money to manufacture. With digital products, the product doesn't necessarily depreciate over time. And we also understand it doesn't cost hardly anything to manufacture because it's all digital. So this is a really, really good business model if you can actually drive people to the platform, sell the product, and you got a lifetime customer value. So this company IPO'd around, let's say what date this is, around 3/31/2021. So it's a recent IPO. We saw them open at around $39. They closed that day around $45. And what we're going to look at is, as a trader, right? How do we want to kind of look at this and kind of determine, is this going to be a good situation for us to play with options? And I want to kind of show you some things that the average person may not pay attention to, but as a savvy trader, you want to kind of look at these things. Now we're looking at the yearly chart, and we know they don't really go out a full year because they just recently IPO'd. And what we're seeing is that, they came out, they hit a high of around $58 on the close, and they've been coming down since then. They had their earnings. They came back up and they started also to come down. And we want to say why the last 3 days red for this particular company. And we're going to talk about that. But we saw them hit this high. They fell down, popped back up and fell back down. So they got a really, really relatively short trading history. Each one of these candles represents 1 day. What I want you to understand is that when you're looking at a really good situation to play for options as a trader, there's certain things that, certain traps that you may want to watch out for, especially when looking at IPO companies. So I sell a course on how to make money out of IPO lockups, SPACs, direct listings. I'm going to give you some of the information that, normally would just be helpful for the people of the course. But if you're watching this on the YouTube channel, you can get access to it. If you want to know more, go ahead and tap into the course. So here's some of the things I was looking at when I'm looking at this company, because I know eventually they're going to have conditions in which it can create a good opportunity for me to play the downside of this play. So we're already seeing this play experience a lot of downside from the original IPO. And we understand that IPOs are not really designed for the retail trade, the retail investors to make money. They're designed for the insiders to be able to exit via the public markets. So we're looking at their statistics. One thing I noticed is that their float is around 18.68 million. That's a relatively small trading float. So they got 130 million shares outstanding, but their float is around 18.68 million. And I got around 52.18% held by institutions, right? So then the question is, with that really, really small float, this particular ticker can really be susceptible, or I would say the proper word is that it can be set up for really, really strong volatility. Because with such a small float, any big buy or big sell can really spike this thing up or down. Now, one of the challenges is that it doesn't do a lot of volume per day. So the volume per day is about 1.5 million, right? That's not bad volume, but it's not a lot of volume. But it can only do so much volume because it's not a really hot ticker. And also it has a relatively small float. So one of the things that you will want to watch out for is that any big buy on this company can really spike this, or any big sale can spike it because the float is so small. So you can end up on the wrong side of a trade if you get those things, because it will not take a lot to move this float because the float is actually so small, right? And currently right now it's not being shorted. So this is why you got to really separate yourself from the narrative that is really being predominant online now, that any selling off in a company is a result of shorts. No. People actually do sell shares, because for you to buy the share, somebody had to sell it. So sometimes a company will sell off because people are not willing to buy the shares at a higher price, but they're willing to sell them at a lower price just to move it. Okay. Also, when you're looking at a company that just recently IPO'd, so they did an IPO through a bank. Banks utilize market makers. I want you to understand is that the market maker's job is to create a market for this company. The market maker will create a market for the company, whether or not the company is going up or company is going down. It doesn't matter to them because their job is to create a market. Because what I want you to understand, and I may actually create a course around this for my VIP people, is that market makers are given shares. Retail buys shares. Market makers are given shares, and they're given shares in exchange for them creating a market for a company. So if I'm a market maker for Coursera, right? So we got Williams firm. I'm a market maker for Coursera, right? Me, the Urban Homesteader, Katrina, and Mecca, we all market make in this particular company. So as a result, as I got a relationship with a particular hedge fund or bank, they give me a certain amount of shares, and I break those shares down to them and say, hey, I want you to help me make a market for the Coursera. So now they've been given shares. So then what does that mean? Doesn't matter what price they sell them at because it's all profit anyway. So now our job is to create a market for this company, right? It's not to worry about the price. It's to create a market for it. Why? Because if I am given shares, I can sell the shares for $10. If I have 500,000 shares that I've been given, I can sell the shares for $10. I still come out on top. Why? Because I didn't pay for the shares in the first place. So you got to understand is that when you're looking at a company like this with a relatively small float, and we understand that the market maker's job is to create a market for this particular company. They don't care if they create a market going up or going down. You don't have a high level of institutional investment. You got a decent level because it's at 50%, right? But the market makers still have to create a market for this particular company. And so we don't know where the institutional investors got in. And we're not so far to the bottom where we got to really start worrying about a price floor yet. It can get there. But I want you to really understand that. So a lot of times when you see selling, we've crafted this narrative now online that all selling of a company is that it's fact that it's being shorted. But we realize now looking at this particular information is that the share showed us 626,000, right, on a float of 18.6. So there's really not share percentage of float is 1.02. So 1% of the float is being shorted. Well, that's not a lot of short percentage. So this isn't being brought about by shorting. It's being brought about by people actually selling. But like I said before, the market maker's job is to create a market, right? They're given shares. They don't buy shares like retail does or institutions do. Institutions buy shares. The market maker's job is to create a market. So their job is to create a market with the price going up, create a price going down. Their job is to create liquidity in the market and be the buyer or seller of last resort, right? That's their job. So it doesn't matter what direction the share price goes to them, because if I was given shares, I don't care if I sell them at $10. They were given to me in the first place. So it's all profit. So I want you to understand that when you're looking at this kind of company, with a recent IPO, they got a relatively small float, but you can see it selling off, right? Now, I want you to also understand something. This company is going to have events that are going to widen the float, right? So here's one of the events that I'm talking about. Okay, that's the wrong page. So this is dated May 6th for OTC Dynamics, and say they're going to announce the partial early lockup, right? And these conditions for this early lockup were satisfied on May 4th. And there's about 34 million shares that become eligible to sell on the public market at the open of trading on May 11th, right? So what I would do is go look at their S1 and maybe some of the other SEC documents to kind of try to better understand that. And if you want to learn how to read these type of documents and understand what's going on, reach out to me about the IPO course. So we understand that this was presented on May 6th, right? So what we're seeing is that this sold on the 5th. It sold on the 6th, and it's selling today. Now we got volume of 1.23 million, which is around its average. We got volume of 1.65 million, and currently today we had a volume around 900,000. So we'll probably hit 1 million before the close of the market today. So the last 3 days are red, but what do we know now? They're getting ready to go into a lockup event, potential lockup event, and we think that it's been satisfied. And so you may have people, right, that are moving out in anticipation of that particular event, right? And it doesn't matter. So it doesn't necessarily mean it's being shorted, I meant to say, but you have people moving out in anticipation of the event. But what we saw here is that it sold off here, bumped up around earnings, and then, traded somewhat horizontal and started selling off again in anticipation of this event, which got satisfied, I believe, what did it say, on the 4th? So they were satisfied on the 4th. So we saw immediately once the conditions were satisfied, it started to sell off. So people are now trying to get out of their position in anticipation of this particular scenario, right? So you really want to understand that. So in looking at this company, the challenge is that, one, the float is very small. So the same way it could go down really rapidly, it's down 7% today, it can also spike back up. Even if, let's say hypothetically, they totally liquidate all their shares, which is 34 million. I doubt that happens, right? The float's still not going to really be that big because we're dealing with a float of 18.68 million, right? So let's say that's 20 million, another 30 million to give us around a 50 million float. It's not a small float, but it's not a really big float either. Okay. But if they increase the float percentage, then what you can have is a lot more shorts, because now you got more shares to short because you can borrow more shares because more shares are available on the particular market. So that's one thing. I doubt all 34 million come out, because what I really think is what's going to happen in this, and I kind of saw this with Snow, is a lot of times when you have these companies with these really, really small floats, you get a lot of volatility from a price standpoint. So what you may get is a sell-off, and then it may spike back up to maybe the $40 or $50 mark, right? And then trade horizontal in anticipation of the next earnings. Their earnings really was not that bad, right? So grew revenue 64% year to year. Profits grew up 74%. Operating costs also grew up, right, to 56%. And, it's costing them more to acquire customers. That's something they got to work on, right? So they had an operating loss of 18.4 million, up 25%. Net loss of 0.45, right? But they gained more. They decreased the loss in free cash flow. But what they're trying to do is try to figure out, how to make a customer acquisition less expensive, right? And make it less expensive to actually operate this company. So what you may see with this particular company is, I don't know how far off their next earnings is. There's probably another 90 days because they just recently had one, which was on May 5th. So we want to kind of see, how does this trade after this early lockup event? Does it rebound back up, or does it start to continue to fall down as it trade horizontal? What we also want to do is observe how big does the float get, let's say a week after the lockup. Do we get a big spike in the float? The only challenge as an options trader is that you're not seeing a lot of liquidity in the options market, right? So one thing, when you're looking at options chains from a scheduling standpoint, when you see May, June, August, November, well, that's not a lot of liquidity because we don't have weekly options. Right. So first thing you want to see, looking for liquidity in the options market, or do we have weekly options contracts? If we don't have weekly options contracts, we don't have a lot of liquidity from a actual scheduling standpoint. Then you want to look at the actual contracts. So just looking at May 21st expiration dates, I'm not seeing a lot of open interest on either side of the actual options chain. Looking at June 18th, not seeing a lot of open interest on either side of the options chain. So the challenge can be that even though, like on this 45, the spread is not that bad, it's not that wide. The spreads are not terrible. This is not bad. The 295, 265 is not terrible. I would look into your own brokerage and like kind of cross-reference a lot of these spreads. They're not terrible. They're not great, but they're not really tight. The challenge is having a market for these particular contracts when you want to exit. So market makers have not really established a really strong options market for this particular company. So therefore, you may have to deal with a lot of spread issues, even if you get the movement that you desire. And you got to deal with liquidity issues, right? Because you're not seeing a really robust market for these options contracts. So even if you get movement that you think may go, whether you believe it to be bullish or bearish, one of the challenges can be is liquidity, and then also issues with spreads, right? Because you're not getting a really tight spread, because these are not really competitive markets for the contracts. So that's something that you want to observe. However, what I want with this company, best case scenario, is for them to rebound from here and get back up around the $60 mark, right? Because what I want the company to be in anticipation of more float liquidity or more float expansion is to be really, really overvalued and then have another not so great earnings. So we're saying another 90 days for them to be really high and then have another not so great earnings, right? So if I can get all those events lined up, it can put them in a position where they really free fall. You understand what I'm trying to tell you? But I think with this type of business model, you're going to see it probably end up, when this is all said and done, probably trading around the $25 to $30 mark when this is all said and done. And it can trade there for a very long time until either the institutional investors pull out or they finally figure this thing out and turn into a very successful company. But if you look at a company that's comparable, so look at a company like Mind Valley. Mind Valley is a privately owned company. The guy that owns that company is probably easily a multimillionaire, right? And it's an online educator. I think lynda.com may be private. So the question we want to ask ourselves again is that why would they take this online education platform public, except because the insiders want to exit via the public markets? It's not necessarily because they have a real justification for going public. Because to me, if you're operating really, really good as a privately owned company, why go public except to exit? You don't understand what I'm trying to tell you? So the question is, yes, you may have some institutions in this company, but institutions spread their capital so broad, it doesn't necessarily mean that it's a valuable company. It just means that they have taken, 1% or 2% in the company because they have so much capital. And if they can get in at $36 and then 90 days later get out at $45, that's a blessing for them. To the retail people, they're looking for a greater return than that. So this is going to be a really basic breakdown of Coursera. What I would do is encourage you to try to figure out who the institutional investors are, what percentage of shares do they actually own, how long have they been in it, and then what are some of the catalysts that are going to happen in this company that can maybe cause this thing to spike up or spike down. And then also you got to really be able to manage that options chain. The options chain is not very liquid, right? It's just not. And so that's something that you're going to have to manage if you decide to get into this particular company. And even if you were selling options in this company, it's still not very liquid. So if you're going to sell contracts, you're going to have to deal with spread issues because, a retail options seller doesn't make the market. The market's made by the market makers. So they can sell over or under the market. It doesn't matter. The market's still made by the market makers. So even if you were to sell options on this particular company, because, you may own a certain amount of shares, it's still not a very liquid options market, which can cause issues in you losing money on the spreads and also cause liquidity issues. So I hope this was valuable to you. If you have any questions, reach out. We're doing the VIP course. We're doing the pre-sale for that. It's going to be till May 14th, I believe, is going to be the pre-sale offer. I have a video on that that's going to be for serious options traders and people that really desire a serious result as options traders. This is David W. Williams, also known as Diamond Dave, and I'll talk to you later.